Yesterday, it was trading around $19 a share. Today, it's sitting near $9.66. If you're just looking at the chart, this looks brutal. It looks like something went very wrong. But here's the key thing up front. This was not a normal crash. This was not an earnings implosion. And this was not the business falling apart. So, in this video, I'm going to explain what Vistance Networks actually does, why the stock dropped roughly 50% overnight, and then we'll get into real bear, base, and bull price targets from here. Let's start with what this company actually is. Vistance Networks is basically the old CommScope, but under a new name. In early 2026, CommScope sold off its cable and connectivity business to Amphenol and gave up the CommScope brand entirely. What was left behind was rebranded as Vistance Networks. Today, Vistance is focused on two main businesses. First is Ruckus Networks. This is the enterprise side of the company. They sell Wi-Fi infrastructure, including Wi-Fi 7, switches, and cloud-managed networking gear. This stuff is used in stadiums, hospitals, schools, hotels, large campuses, places where needing fast, reliable Wi-Fi really matters. If you've been in a stadium or large venue with surprisingly good Wi-Fi, there's a decent chance Ruckus equipment was involved. Second is Aurora Networks. This is the service provider side. They sell broadband access equipment to internet and cable providers, things like DOCSIS platforms, fiber access, and last-mile network infrastructure. So overall, Vistance is an infrastructure company. This is not a software hype stock. It's physical networking gear used by enterprises and ISPs. Now, let's talk about the crash, because this is where most people get confused. The stock did not collapse because investors panicked. It dropped because of a one-time cash distribution tied to the breakup of CommScope. Here's what happened. When CommScope sold its cable business, Vistance received a huge influx of cash. After paying down debt, management decided that a lot of that cash wasn't needed to run the business, so they returned it directly to shareholders via a large special distribution. We're talking roughly $10 per share being given back to investors. When a company does that, the stock price automatically adjusts downward to reflect the fact that cash has left the business. So if the stock was about $19 and around $10 per share is paid out, the remaining stock will naturally trade around $9 to $10. That's exactly what you're seeing today. This is similar to what happens with special dividends or spin-offs. The value doesn't disappear. It moves from the share price into shareholders' pockets. This is why the chart looks terrifying, but the underlying reason matters a lot. This is not a blow-up situation. If this were a real crash, we'd be talking about missed earnings, debt problems, customer losses, or a broken business model. None of that happened. In fact, Vistance now has a much cleaner balance sheet, far less debt, and a sharper focus on higher-margin networking businesses. Management intentionally returned excess capital instead of hoarding it. Now, post-distribution, the new Vistance is a smaller but cleaner company. They're focused on enterprise Wi-Fi upgrades like Wi-Fi 7, and on broadband upgrades from service providers moving toward faster fiber and DOCSIS systems. That said, this is still a hardware-heavy company. Growth depends on IT budgets and ISP spending cycles. That means revenue can be lumpy, and the stock won't trade like a smooth SaaS name. You also tend to get technical pressure after big price adjustments like this. ETFs rebalance, short-term traders exit, and the stock can stay volatile for a while. So now the real question becomes, what is this business worth going forward? Let's talk price targets. Starting with the bear case. In a bear scenario, enterprise spending slows, broadband capex gets pushed out, and growth stays muted. The stock doesn't collapse, but it trades like a slow-growth infrastructure name with limited excitement. In that case, I'd see VISN trading around $7 to $8 per share. That would imply lower valuation multiples and continued investor caution. Now the base case. In the base case, Ruckus continues to grow with Wi-Fi 6E and Wi-Fi 7 upgrades, broadband spending stays steady, and the company executes without major surprises. In that scenario, I think VISN can reasonably trade back toward $11 to $13 per share over time. That would be the market recognizing the cleaned-up balance sheet and the stable core businesses without overhyping growth. Now the bull case. In a bull scenario, Wi-Fi 7 adoption accelerates faster than expected, enterprise spending holds up, and Aurora benefits from renewed ISP infrastructure upgrades. In that case, investors start valuing Vistance as a focused networking platform instead of a leftover spin-off. That's where you could see $15 to $17 per share again down the road. Not quickly, not in a straight line, but over a longer rebuild cycle. The key takeaway here is this. You can't simply look at yesterday's $19 and say, wow, $9.66 is cheap. Part of that value was already paid to shareholders. The real question is whether the remaining Ruckus and Aurora businesses are worth around $10 a share. Now, if you believe in enterprise networking demand and broadband infrastructure upgrades, this stock may quietly rebuild from here. If not, it could stay range-bound and boring. Either way, today's 50% drop is not the disaster it looks like on the chart. As always, this is not financial advice. Do your own research, manage risk, and I'll see you in the next one.